I'm Bob Rozewski. Once upon a time, there was a man named Willie Sutton, and Willie Sutton made his career out of robbing banks. He spent a lot of time robbing banks, and he also spent a lot of time in jail because of it. Well, one day, a reporter said to Willie Sutton, "Willie, why did you rob the banks?" And Willie responded, "That's where the money was." Well, your career won't involve robbing banks, I'm sure, but when it comes time to needing financial services, we go to financial institutions. That's where the money is. Financial institutions cover a broad range of services that we make use of from time to time, and today we want to discuss what those institutions are, what the services are. Let me say first in the broad sense that a financial institution acts as a sort of middleman. At any given time, you or your company or your city, your state, the federal government has more money on hand than you really need for immediate purposes. And you take it to a financial institution, you entrust it to that institution to take good care of it, to put it to work for you as the case may be, and at the same time there are other individuals or companies or governments that have need for money that they don't have on hand at the time. They go to financial institutions as well to borrow it. And so there you see the financial institution acting in the middle, taking in the funds from those who don't need it at any given moment, lending it out to those who do. The financial institution plays the role of a middleman. It is only fair that they make a fair profit because we want to be sure that the financial industry is ongoing so that we can have a sense of trust in them. And the profit, of course, is the difference between what they take in on their loans and what they pay out to us when we invest our money with them. And it's nice that they do make a fair profit. If they didn't, we would all be kind of worried about them. Let's take a look now at what some of the financial institutions are, and a little bit later on we'll examine some of the specific services. First and foremost, probably in terms of familiarity, is your own bank. The bank where you deal with probably with a checking account, you may have your car loan there, things like that. There are about 15,000 banks throughout the country, and that doesn't count all their individual little branches. It's a very large industry. Bank deposits, your money that you put into the bank, savings accounts, checking accounts, are protected by a form of federal insurance. A federal agency called the Federal Deposit Insurance Agency, or FDIC, insures all of your accounts against the failure of the institution, and nobody has ever lost a penny in a federally insured account at banks or at savings institutions or at credit unions. And that does bring us to the next category, savings institutions. There are basically two types: mutual savings banks, which tend to be located more in the northeast and midwestern part of the country. They too are insured by the Federal Deposit Insurance Corporation. And then there are the savings and loan associations, which are concentrated more in the western part of the country, but they do spread out over the entire 50 states. And savings and loans are insured by the Federal Savings and Loan Insurance Corporation, FSLIC. Next we have the credit unions, and there are many, many thousands of credit unions. Credit unions are insured by the National Credit Union Association, NCUA, which is also a federal agency. Credit unions are created among people with a common bond, people that work for the same company, people that work or belong to the same union. They are not profit organizations, so their facilities may be a little more modest. They may offer a better deal to their customers than banks or savings and loan associations do. Of course, you have to check out for yourself and make use of those institutions which offer you the best arrangements. Next we have finance companies, which are known also in many areas as small loan companies. These companies do not take in public deposits. They don't have the same kind of insurance. They will go out and borrow money themselves from banks and turn around and make relatively small loans to individual consumers to buy furniture, appliances, cars, whatever purpose there may be. And there are many thousands of those all across the country. Now, the next two items I'll just cover rather briefly. Stock brokerage firms and insurance companies, they are, generally speaking, financial institutions, not quite in the same sense as the other ones we've talked about, but they will help you put your money to work. You do entrust your money with them. They do provide a wide range of services, and thus they fall into the category of financial institutions, and you will make use of them from time to time. Now, something is emerging that I want to talk to you briefly about, and that is what I'm calling the financial supermarket. And this really just began to occur around the start of the 1980s, and it will be a trend that will be continuing throughout the 1980s and well into the 1990s. And the financial supermarkets will be a blending of all these other different types of financial institutions. A large firm which offers the services of banking and savings and stock brokerage and insurance brokerage, et cetera, et cetera. You'll be able to go to one of these places and get all of your financial matters handled under one roof, so to speak. The financial supermarket, it is a trend that is emerging. The distinctions between the other forms of institutions will be blurring. You as a consumer can take good advantage of these new financial supermarkets, but you'll have to keep a keen eye on just what services you're getting from whom and do a little more shopping, because the competition, I think, will become more fierce than it has been. Financial supermarkets bode well, I think, for American commerce and bode well for you if you keep yourself alert. Another phase of the ongoing revolution or evolution in the financial industry is the rapid emergence of electronic banking, which is part and parcel of the financial supermarket. Many of the person-to-person transactions you've been used to doing will now be replaced by electronics. You've probably seen the machines already, the electronic teller machines. No eyeball to eyeball with another human being. Now it's a plastic card in a slot. You make deposits, you get money out, you make loan payments, etc. Again, something that you can take good advantage of, and it can keep your overall financial costs down in the transactions you'll be involved in. Now I want to take a look at some of the specific services that you can utilize when you get involved with financial institutions. We'll be concentrating on the major types of services that you'll generally find at banks, savings associations, and credit unions. And for the most part, you'll find most of these services available at most of those institutions. We have checking and savings accounts. We'll get back and look at those in more detail in a few minutes. Consumer loans such as car loans, home improvement loans, the credit cards that you get at the institutions, you're familiar with those. Home loans, which allow you to finance the purchase of a home. Trust accounts, which allow you to put aside money for some future purpose or for some person's needs in the future. Special checks such as cashier's checks and certified checks, and safe deposit boxes, which basically allow you to rent a steel box in a safe place to put away valuables for safekeeping purposes. Now let's get into checking accounts, which is probably the most familiar type of service available at a financial institution. It's not too difficult in the area of writing a check. You write a check to pay your bills or what have you, and of course if there's enough money in the account, no problem. There's a little bit more complication that arises when you receive a check. What do you do with it, what happens to it, and what are the complications that can arise when you receive a check and want to negotiate it? You want to transact it, put it through its normal routine. Let's take a look at some of the situations that you must bear in mind when you are negotiating a check. First of all, if you look at the front of a check, you'll see it's written pay to the order of whomever it may be. Let's say it's you, and let's say your name is John Doe. Pay to the order of means that the maker of the check is giving an order to the bank to pay you whatever the amount of the check may be. Now, before the bank can honor that obligation, it must know that you have received the money that was promised to you, that was paid to you in the proper way. And in order for the bank to know that, you must do what's known as endorsing the check. You sign your name in one fashion or another across the back of the check. It's known as an endorsement. That is your acknowledgement that you have, in fact, received what the pay to the order of was intended to provide. And endorsements of checks can take different forms. Perhaps the most common that you'd find is a blank endorsement, not necessarily the best way to do it. You receive a check payable to John Doe, and you endorse your name across the back with nothing else but your name, John Doe. Now, if you lose that check, anybody can pick it up and take it to a bank and cash it if they can phony up some identification for themselves. So you really shouldn't use a blank endorsement unless you're standing right at the teller window, ready to give them the deposit and get a receipt for it immediately. A blank endorsement is not the best thing to do. There are two other types of endorsements that you might find more feasible, the restrictive endorsement or the special endorsement. If you're going to deposit the check into your account, then it would be smart to use the restrictive endorsement, which would say you write there, for deposit only to account number 9876, and then sign your name. Now, what you've done there is ensure that the check can be deposited only to your account and cannot be transacted in any other way. Now, if you don't want to actually deposit the check to your account, but instead you want to, say, pay a debt to another friend with it, or pay a store bill, you can use what's known as a special endorsement. You write on the back, pay only to, and then put in the name of the friend or the store as the case may be, and that means that that's the only way that that check can be negotiated. The special endorsement, the restrictive endorsement are to be preferred over the blank endorsement. Now, what happens then to the check after it's endorsed? Where does it go and what becomes of it? This diagram will illustrate. Now, let's say that you deposit a check in your bank that was drawn on a bank from out of town. Your bank then has to send that check out to collect the money that's got to be going into your account. And until your bank knows that those funds are collected, they probably won't let you draw against that money. What happens then? Your bank sends the check out to a clearing bank, which is another institution that sorts out all of the checks from all the banks and sends them where they're supposed to be going. The clearing bank, in turn, sends it back to the bank of origin, the bank upon which it was originally drawn. And if the check is good, if it is honored, then your bank will eventually be able to honor the check that you deposited. However, if the check bounces when it reaches the bank of origin, they will send it back through the clearing bank back to your bank, and you'll receive a notice saying the check has bounced, and any checks you may have written against it will accordingly bounce as well. Now, we have talked there about a situation known as uncollected funds. You have to be sure when you deposit a check into your account, particularly if it's from an out-of-town bank, as to how long it will take before those funds will be collected, before you can draw against them. Because if you do draw against uncollected funds, you're going to have some extra costs and some embarrassment. If you're dealing with a check drawn on another local bank, the collection time may only be a few days. However, if it's a bank in another community, it may be as much as a week or two. So check with your banker before you make the serious error that would involve drawing against uncollected funds. Related to uncollected funds is what's known as an overdraft, which simply stated means you have drawn out more money than you have in your account or attempted to. Your check will bounce. You'll have to pay some fees for that. You'll have some embarrassment explaining to the supermarket why you drew a check when you didn't have enough money in the account. Another concern about checking accounts is if you write a check and then after you've written it and given it to whomever, you want to stop payment on it. You don't want the check to go through as you'd originally planned, and you have a valid reason for doing so. You must go into the bank, complete and sign a valid stop payment order. And if you do so, and only if you do so, then will the bank actually stop payment on the check. Another concern that you have to evaluate when you're shopping for checking account plans are the costs that you'll incur. What will be the service charges for the account, how much per month, how much per check, how much per deposit, and so on. And if you have what is known as an NOW, a negotiable order of withdrawal account, otherwise known as a checking account that pays interest, which are becoming very common, you'll also have to evaluate how much you're going to earn, what is your minimum balance that must remain in the account, and so on. Do that evaluation very carefully because you can save money or earn more money with the right kind of checking plan. Now let's turn to savings accounts, and there are basically two types of savings accounts. One is the more old, traditional, familiar passbook account that allows you to put in and take out as much money as you want anytime you want. You'll get much less interest rate on the passbook savings account than you will on the certificate account or certificate of deposit. That is a fixed contract for a fixed amount of money for a fixed amount of time. If you want to cash in early, you'll probably have to pay some kind of penalty. So evaluate very carefully just what you're getting into before you get in. Both can be excellent investment programs. As I noted earlier, these types of accounts are insured by the agency of the federal government. There's another area that is compounding of interest that has to do with savings plans, and I want to just quickly review what compound interest is. You probably learned about it when you were in grade school. You may have forgotten what some of it means, but it is important to recall how compounding of interest works. Essentially, compounding of interest means the interest that you earn on your account goes back to work in your account to earn more interest for you. Here's an example. Let's say we have an 8% annual compounding on a $1,000 investment. During the first year, you will earn $80. 8% of 1,000 is 80. That's added to your balance, and at the end of year one, you have $1,080 working for you. That will earn 8% in the second year, or $86.40. Add that to the starting balance of year two, and you have $1,166.40 working for you, and so it goes. Your interest earned goes back into your account to continue earning more interest for you. Now, I've given you an example of annual compounding. If you want to look at a more frequent type of compounding, which you'll find at most institutions, quarterly or even daily, your growth of money will take place at an even faster clip. Check it all out before you involve yourself in a savings plan to make sure you're getting the best compounding plan for your money. Now let's take another look at some of the other financial services that you can find at these institutions. The next item is consumer loans. Now, consumer loans cover a wide variety of needs. If you're going to buy a car, fix up your home, take a vacation, you can borrow money. Usually you'll find it'll be on the installment plan. That means you'll borrow the fixed sum of money, whatever it is you need, whatever they're willing to lend you, and you'll repay it in equal monthly installments over 1, 2, 3, 5 years, however many years you work out with a lender. Make sure when you are shopping around for installment loans, consumer loans, and you should shop around, compare the interest rate by comparing what's known as the APR, annual percentage rate. According to federal law, that's the way loan rates must be quoted. Compare the APR, don't forget that. Credit cards are another type of consumer loan. Actually, a credit card allows you to write your own loan anytime, any place you want. Use your credit cards most judiciously. If you abuse them, you'll feel abused because those high interest rates will come pounding on top of you and you won't know what hit you. Credit cards can be wise only, though, if used judiciously. The next item is home loans. These are generally available more frequently at the savings type institutions. And if you're shopping for a home, let me suggest that you shop for the money before you shop for the house. Go and visit the lenders. Find out what kind of loan they can make to you. That'll allow you to go out and shop for a home in the right price range for yourself. You can also inquire at banks and other institutions for home loans, but the savings institutions are the ones that deal more frequently with it. Trust accounts are something a bit unusual and not too frequently used. Let's say that you want to put aside a sum of money for your son Johnny's college education that's to be held safely for about 10 years and then paid out. You can go into a financial institution, a bank or such, and open up a trust arrangement, and you will give them the money with instructions to invest it according to your wishes and to pay it out to Johnny or to Johnny's college 10 years from now. There are legal involvements, there are fees involved. Check carefully with the banker before you enter into a trust arrangement, and do it only when it's really the best possible way for you to handle such particular matters. Banks and savings institutions offer special checks. Let's say you're buying a house and the seller wants to receive a check at the closing date that will be absolutely guaranteed. He doesn't want your personal check, he wants something more guaranteed than that. You can give him a certified check, which is a check on your account, but which your bank has certified that the money is in the account and will remain in the account until that check is presented. Or you can get a cashier's check, which you buy from the bank, and in effect you are buying a check drawn on the bank's own account. It's the bank's check, and it'll certainly be good when you present it to the seller in that deal or any other type of deal. Another kind of special check is a traveler's check that you can obtain at financial institutions for a modest fee, or in some cases no fee. They're wonderful to use when you're traveling. They're insured against loss, easily replaced, and a traveler's check is something, if you're particularly going to be out of the country, traveler's checks are the way to carry your money. Safe deposit boxes are another feature offered at most institutions. In effect, you rent a metal box that's secured in a vault. You pay an annual fee for the use of the box. You put your valuables in it. Some institutions will even give free safe deposit boxes to their very good customers. Discuss all of these services with your banker before you embark on them so you'll know what the cost and legal ramifications are. Speaking of legal ramifications, what are your legal rights as a user of financial services at financial institutions? There are quite a number of laws. Let's take a look at the most important ones. They're both state laws and federal laws that govern your rights, and I can only give you kind of a tip of the iceberg look at them, but I'll point out what those laws are, how your rights are affected by them. Then, of course, you have to pursue your rights if something comes along that looks like a problem to you. Under the state law category, bear in mind that each state has its own body of laws, and they will differ from state to state, so you have to check in your own state exactly what these laws are. First is the Negotiable Instruments Law, and that governs the flow of a check, for example, or a contract, which is an instrument which is negotiated from person to person to person. It has to do with the endorsements that we talked about earlier. If there's a wrong endorsement on a check and you find yourself out some money, for example, you may have to look for your recourse under your state's negotiable instrument law. The usury laws of each state set the maximum limit that can be charged on interest on different types of loans. And each state, again, has different usury laws as to how much the legal maximum interest rates are. And within each state, there may be different usury limits for different types of loans. Car loans may have one legal interest limit, home loans may have another, and it can be kind of tricky, so you should check with your own state laws to find out what the situation is there. Secured transaction laws have to do with situations where you give collateral or security for a loan that you receive from a lender. For example, you are taking a car loan at a given bank or a savings association, and you sign over papers giving them security or collateral of your car, which means that they can come and repossess your car, take it away from you if you fail to make payments. Now, the secured transactions law of each state require, in one way or another, depending on the state, that the documents, the evidence of that lien, that right to repossess, be recorded in some public office so that the world knows that that bank has first dibs on your car. When your loan is finally paid off, the bank may be required to release that lien, to take it off the recorded books so that you are free and clear with that car, so to speak. And again, before you enter into a loan transaction that does have a security interest, such as your car or any other collateral you may be giving that's subject to these laws, check to make sure you know what your rights are under the laws. Now let's turn to the federal body of laws. And here too, I want you to double check at any given time, because all these laws are subject to change by Congress and subject to new interpretation by the courts. And what specifically your rights are today under these may be different from what they were when the laws were first passed. First, we have what's known as the Truth in Lending Law. Earlier, I referred to the annual percentage rate, or APR. It's the Truth in Lending Law that requires institutions to quote that interest rate in terms of APR, annual percentage rate. I can't emphasize that enough, because that's the apples versus apples way of doing comparison shopping for loan rates. The Truth in Lending Law also stipulates that in certain kinds of loan transactions, you are given a 3-day cooling off period. In other words, a 3-day cooling off period during which you can cancel the loan, receive back any down payment you may have paid, and a lender is required to give you notice of that 3-day right of rescission. It can come into play, for example, where you are giving a second mortgage or second trust deed on your home for home improvement work that is being done on your home. That's where that 3-day cooling off right would come into play. Make sure you know that right and double check with any banker before you get involved in signing papers to know what your rights are under this law. Next is the Fair Credit Billing Law. I'm sure, like most people, you've had that day when you get a bill from the department store or somebody that's wrong, the computer is goofed, and you call up to say, you made an error on my bill, and you talk to another computer and another computer, and you tear your hair out. Well, the federal Fair Credit Billing Law is designed to take care of those problems. If you have an incorrect billing that you receive, you have certain rights to have that bill corrected before you can be hit with service charges or collection procedures. And all lenders are required to notify you, as well as all stores who grant credit on charge accounts, to notify you periodically of your rights under the Fair Credit Billing Law. If you have any questions about it, talk to the store credit manager, talk to the loan officer at the bank, and be certain you follow how the law sets out those rights if you want to be fully protected. Next is the Fair Credit Reporting Law. And this allows you to examine what is in your credit file at the local credit bureau, because sometimes mistakes can creep into the credit file and you will find yourself being denied credit because someone with a name similar to yours had a bad record and his bad record got transferred over to your file, things like that. You should periodically check your credit history. There may be a minor fee involved, a few dollars, in order to do so. Check your credit history to make sure it's accurate, to make sure that disputed amounts are properly illustrated, and that in case of an error, that the credit bureau does take the proper steps that it must under the law to remove or clarify any errors or misleading information. Next is the Equal Credit Opportunity Law, which says in a nutshell that nobody should be denied credit because of race or sex, and you should examine what your rights are under that law at the time you're applying for credit. If you feel there's any slight abuse, talk immediately to the banker and then proceed to the Federal Trade Commission for rectification of any problems that may occur. Next is the Fair Debt Collection Practices Act, which prevents debt collectors from unduly harassing you if you owe a bill. Pay attention to all these laws. Those rights are important, and as I've said so many times before, if you don't pursue these rights on your own, nobody else is going to do it for you. The final step in dealing with financial institutions is to create a personal rapport with one of the officers or more of the officers that you're dealing with, so that you can have that person-to-person relationship, to get accommodation when you need it, to get a favor done when you need it. It can be really very valuable to you. All things considered, of course, financial institutions play a very important role in our personal financial lives. And you really must, from time to time, be sure you understand exactly what's going on, because there's a flood of new regulations, new investment opportunities, new laws, new taxes that come into play, and all of these, in one way or another, will flow through or bounce off of your financial institution that you're doing business with. So pay attention, keep yourself up to date, and make the best possible use of your financial institutions. I'm Bob Rzewski. Thanks for tuning in.